This is your last chapter, chapter 12, and this is capital investment decisions. And this is part 2. We went over payback and accounting rate of return. Now we're going to look at net present value and internal rate of return. So again, we're going to use this type of analysis whenever we're looking at making large capital investments. And we've looked at payback, which is how fast cash investment will be recouped. And again, it's for short lifespan investments. Accounting rate of return indicates profitability, again, short lifetime investments. And now we're going to look at the two that we can use for longer lifespan, which is net present value and internal rate of return. We're going to focus on the cash flow. We're going to look at how much we have to spend and how much we get back in return. But since we spend it today, we have to compare it to cash inflows based on today's dollars. And that's what we're doing when we're looking at present value. So we're trying to convert those future dollars into today's dollars. That's why we use present value tables. So this takes into consideration the time value of money, which means invested money earns income over time. Cash received sooner preferred over being received later. To determine the present value of future sums, you use the present value tables. Factors. We have the principal, and then we have a single sum, which means it's a specific amount that we're going to receive sometime in the future. And that we're going to look at the present value of a single sum table. Also, if we have multiple payments, but they're all different amounts, we'd also use the present value of a single sum table. And then we have what we call an annuity. And we determine the present value of a stream. They have to be equal that will be received in the future. Now our formula, in order to turn something, a stream of money or one lump sum into today's dollars, we're going to take the amount we're going to receive times the present value factor. And again, we locate it based on the number of periods. We go down the side of the table, down the side on the left, and then we go across to the interest rate for that period. And the period is usually years in our examples. Now again, Table A, present value of a dollar, we're using that for single payments or multiple payments of unequal amounts. And we use Table B, which is in your book, which is the present value of annuity when you have two or more payments, but they have to be equal. Now, discounted cash flow models recognize the time value of money. There are two methods, net present value and internal rate of return. Net present value. Discount rate required minimum rate of return given riskiness of investment. Remember, the higher the risk, the higher the return required. So when the net present value is greater than or equal to 0, then you're going to want to do the project, assuming everything else has been looked at. So also make sure you take into consideration any residual value. So what's our decision like? Well, if the net present value is positive, then we're going to invest. So let's take a look at an example, see how this works. So here's our example. We're thinking of investing, expanding our ski resort. We know that if we do it, we're going to get 118 additional skiers per day. We have an average number of 164 ski days per year. The life of this expansion is 10 years. The average cash spent each day is $238, but we have variable costs of serving each skier each day of $134. It's going to cost us $9.5 million, and we want a discount of 12% and also assume straight line depreciation, and it has a residual value of $700,000 at the end of the 10-year service. So let's first look at the net present value of this project. So first, we have our annual amount we're going to receive, which is the $238 minus the variable expenses times 118 skiers a day times 164 ski days equals $2,012,608, and we're going to take it times our present value of annuity factor, which is we go down 10 periods and we go across 12% interest, and it tells us has a net present value of $11,371,232. And then we're going to get the present value of the $700,000, which is again factor of 10 on the present value table, table A. Interest, we go across to 12%, we get the factor of 0.322, and that tells us that we have a net present value which is positive, which tells us we should do the project. Now let's look at another project, and first let's look at the payback. We want to spend $550,000, and it would cause a cost savings of $80,000 per year, and these panels should last 15 years. Okay, it's going to take us 7 years to get our money back. That's a long time. If the company has a discount rate of 10%, what is the net present value? Initial investment. And then we're going to go to the annuity table, and what it tells us is it has a net present value of $58,480. So, if the company requires a payback of 5 years or less, then they should not do the project. But if they do it based on net present value, since it creates a positive cash flow, and you have no other projects you're comparing it to, then you might want to get the solar panels. Now, net present value of unequal flow. When annual cash inflows are unequal, you must use the present value applied to each annual cash inflow. So here's our example. If you notice, we've got 6 years, but every single year is different. We have to invest $910,000, and they want a return of 16%. So this is our initial investment. We have to go to the single sum, table A, and get the present value factor for each year. And that will give us the net present value for each year. We're going to add those up. And it tells us this project has negative present value, which means we're not getting a rate of return of 16%. So we probably shouldn't invest. Now, what if they come back and say, wait a minute, if we refurbish at the end of 6 years, and it provides an additional $74,000 of net cash, and we can sell it for $50,000 at the end of 7 years, should we do it? So we're going to take the present value of the additional investment. Remember, we're going to do it in 6 years, so we got a present value of that. And then the present value of the the income we're going to get at the end of 7 years, along with the residual value. We're going to go to the present value table of, for 7 periods, 16%. And it tells us it has a positive, but it still does not overcome the net present value from the original calculation, so we would not do this project. Now, advantages: it incorporates the time value of money, indicates that assets will earn minimum required rate. The disadvantage is difficult to compare investments of different sizes. However, profitability index can be computed for capital rationing decisions. So that's just another way of looking at it. Now let's look at our last, which is the internal rate of return. It's the rate of return a company can expect to earn by investing in a project. The interest rate that will cause the present value to equal 0. Find the discount rate that makes the cost of the investment equal to the present value of the investment's net cash inflow. So first, we need to find the annuity present value factor. We're going to take the investment divided by the annual net cash inflows. And then we go to the present value table, which is table B in your book, and we're going to scan the row looking for the corresponding based on the expected life, and we're going to find the factor that best is closest to the number we get. So, if the internal rate of return exceeds required rate of return, we're going to invest. So we're going to look at 2 projects. Project A, $280,000 investment today, and we'll get 8 annual payments of $56,000. But because this is a risky project, we expect a 16% rate of return. Then we have the project B, which is $380,000 and offers 9 annual payments of $74,000, and since it's less risky, we only require a 12% rate of return. So here's our initial investment. Here's the present value based on its annuity. It's for 8 years, 16%. Project B, initial investment, less. It's the annuity factor, 9 years, 12% times the 74. And it has a positive, so Project B looks like we should do it. Now, what is the maximum to pay for each project? For Project A, we should not pay more than $243,262. We expect to get 16%. Project B, we shouldn't pay more than $394,272 if we want 12%. What's the internal rate of return? Well, for Project A, we take the 280 divided by the 56, gives us a factor of 5, and we go across our table, and we see it falls between 10 and 12%. And for Project B, it falls between 12 and 14%. So again, Project B looks like it's the best choice based on the internal rate of return, which is the same thing we got when we did net present value. So, advantages of using this method: incorporates time value of money, computes the actual rate of return. No additional steps needed for capital rationing. Disadvantage: assumes that all cash inflows are reinvested at a rate equal to the internal rate of return. And this ends Chapter 12.